Hello, dear students and scholars. I hope you're doing well and I'm glad you're here. We have now studied the three main ASC 320 buckets: held to maturity, trading, and available for sale. Today, we move into the advanced part of the topic: transfers between categories, credit loss boundaries, structured notes, and related ASC topics. This is where ASC 320 becomes more judgment based. The basic categories are still the foundation, but now we ask harder questions. Can a security move from one category to another? What happens to AOCI? Which credit loss model applies? And when does another standard, such as ASC 326 or ASC 815, take over part of the analysis? This video will help you map that advanced terrain before we move into CPA level multiple choice questions. Transfers between trading, AFS, and HTM are expected to be rare. ASC 320 does not treat classification as a casual relabeling exercise. A transfer should reflect changed circumstances, not income management. Why is the standard strict? First, frequent transfers could allow gains trading, where management selectively moves securities to create a preferred earnings result. Second, transfers can weaken classification discipline. Third, repeated transfers, especially out of HTM, can damage management credibility and may call the remaining HTM portfolio into question. Fourth, transfers should not be used to push losses into OCI or pull gains into earnings whenever convenient. In simple terms, category transfer is not accounting musical chairs. You cannot keep changing seats just because the earnings music changed. Transfer accounting starts by identifying the old category and the new category. The old category tells us what has already been recognized. For example, trading has already sent fair value changes through earnings, while AFS may have amounts sitting in AOCI. The new category tells us what measurement model applies going forward. We also need measurement at the transfer date, not an old balance and not an average. Then we decide what to do with prior balances: recognize them in earnings, preserve them in AOCI, reverse an allowance, or amortize an amount over time. After the transfer entry, the security follows the destination category: fair value through earnings for trading, fair value through OCI for AFS, or amortized cost for HTM. When a debt security moves from AFS or HTM into trading, any unrealized gain or loss not previously recognized in earnings must enter earnings at the transfer date. On the slide, the previous category is AFS, amortized cost is $100,000, fair value at the transfer date is $103,500, and the prior unrealized gain in AOCI is $3,500. Because the security is moving into trading, that $3,500 deferred gain is reclassified from AOCI into net income. The reason is straightforward. Trading securities report fair value changes through earnings. Once the security enters trading, it cannot keep an AOCI balance quietly hiding in the corner. When a security moves out of trading into AFS or HTM, the transfer is recorded at fair value on the transfer date. The key point is that prior trading gains and losses have already passed through earnings. ASC 320 does not reverse them. If fair value records are not current at the transfer date, the remaining mark to market adjustment is first recognized through earnings, and then the transfer is completed at the updated fair value. If the destination is AFS, that fair value becomes the new starting basis for AFS reporting. If the destination is HTM, that fair value becomes the new amortized cost starting point, with any premium or discount amortized over the remaining life. Trading already did the earnings work, so the new category receives a clean starting point. Now let us look at a transfer from HTM to AFS. This is sensitive because HTM is a commitment category. First, any existing HTM credit loss allowance under ASC 326, subtopic 20, is reversed through earnings before the security leaves HTM. Second, the security is transferred at amortized cost. Third, Once the security is in AFS, the entity evaluates whether a new AFS credit loss allowance is required under ASC 326 subtopic 30. Fourth, the difference between fair value and the amortized cost transfer basis, excluding credit loss amounts covered by the allowance, is recorded in AOCI. Fifth, management must assess whether the transfer calls into question its ability and intent to hold remaining HTM securities. HTM credibility is serious. Once that trust is damaged, auditors do not simply say, no problem, carry on. A transfer from AFS to HTM has a different issue. The security is moving toward amortized cost reporting, but the unrealized holding gain or loss already sitting in AOCI does not simply disappear. First, any AFS credit loss allowance is reversed through earnings before the security exits AFS. Then the security enters HTM based on its amortized cost basis, adjusted for the AOCI effect. The AOCI balance remains in equity and is amortized over the remaining life of the security as a yield adjustment. After transfer, the security follows the HTM credit loss model under ASC 326 subtopic 20. The memory line is useful. AFS to HTM changes the path, not the history. Accounting does not use a memory eraser, it unwinds the prior AOCI amount through yield over time. Credit loss analysis depends on the category. AFS and HTM do not use the same model. For AFS debt securities, the governing model is ASC 326 subtopic 30. Credit losses are recognized through an allowance charged to earnings, and that allowance is limited by the amount that fair value is below amortized cost. Non-credit fair value declines remain in OCI. For HTM debt securities, the governing model is ASC 326 subtopic 20, which uses the current expected credit loss model or CECL. Expected credit losses are measured over the life of the instrument on the amortized cost basis. No OCI component is involved. This slide is a boundary map, not a full CECL lesson, but it tells you which doorway to enter. For AFS debt securities, a decline in fair value is not automatically a credit loss. That is one of the biggest exam traps. If the decline is credit related, the credit loss is recognized through an allowance for credit losses charged to earnings. The allowance cannot exceed the total amount by which fair value is below amortized cost. But if the decline is caused by non credit factors such as interest rate movements, liquidity changes, or general market conditions, that non credit portion remains in OCI. There is also an important sale intent rule. If the entity intends to sell the security or is more likely than not required to sell before recovery, the security is written down to fair value through earnings and the allowance approach is not used. Market price decline is a warning signal, not the final answer. For HTM securities, the loss boundary is different. HTM securities are carried at amortized cost, so the AFS fair value through OCI mechanics do not apply. Credit losses for HTM securities are recognized through an allowance charged to earnings under the CECL model in ASC 326 subtopic 20. The amortized cost basis is the starting point for credit loss calculations and interest income recognition. A fair value decline by itself does not drive HTM measurement if the decline is not credit related and management still has intent and ability to hold to maturity. But HTM classification does not remove the obligation to assess credit losses. HTM can ignore market noise for measurement, but it cannot ignore credit deterioration. That is the difference. Structured notes add another boundary issue. A structured note may be a legal debt instrument, but its cash flows can be linked to indexes, interest rates, foreign exchange rates, commodity prices, prepayment rates, caps, calls, floors, or other variables. If the instrument meets the definition of a debt security, the analysis still begins with ASC 320 for classification and measurement. But complex cash flow features may require special interest income analysis. Embedded features may also point to ASC 815 to determine whether a derivative feature must be separated and accounted for independently. If the structured note is classified as trading, fair value changes flow through earnings. The memory line is excellent. Do not let the word debt hide the economics. Sometimes the label says debt, but the cash flows are doing gymnastics. ASC 320 is the core standard for debt security classification and measurement, but adjacent standards can control specific parts of the fact pattern. ASC 326 governs credit losses on AFS and HTM debt securities. ASC 820 provides fair value measurement and hierarchy guidance. ASC 825 may apply when the fair value option for financial instruments is elected. ASC 815 governs derivatives, hedging, and bifurcation. ASC 860 addresses transfers and derecognition of financial assets. ASC 321 reminds us that equity securities are not ASC 320 debt securities. The key is not to overexpand. Apply ASC 320 for debt security classification first, and then layer in the adjacent standard only when the fact pattern requires it. Let us close with the boundary checklist. First, confirm the instrument is a debt security in ASC 320 scope. Second, identify the current category, trading, AFS, or HTM. Third, if a transfer is proposed, ask whether it is truly supportable and rare. Fourth, determine whether the transfer sends any unrecognized amount to earnings, especially when moving into trading. Fifth, trace AOCI carefully. Is it preserved, reversed, cleared through earnings, or amortized as a yield adjustment? Sixth, separate credit related loss from market related decline. For AFS, use the AFS credit loss model. For HTM, apply CECL. Seventh, check whether ASC 815, ASC 820, ASC 825, ASC 860, or ASC 326 controls a separate feature. In the next video, we will test these rules through CPA level multiple choice questions. If this lesson helped you, please like the video, subscribe to the channel, support the course, and share it with your colleagues who are learning US GAAP. I will see you in the practice session.